welcome to the Money Show right here on ET Now. I'm Avan Dubash. This is the only show of its kind where we get you a top financial expert to answer all your personal finance related questions. Well, today on the show, we will be getting all your questions answered. So do connect with us. You can dial in to the number that's flashing on the bottom of your screens or simply email us your mutual fund related queries on the Money Show at etnow.tv. Tarun Birani, founder and CEO, TBNG Capital Advisors, is with us to guide you over the next half hour. Tarun, great to have you with us in our studios. To begin with, we've got lots of questions. So let's start off with the first query of the day. This has been sent in to us via email on the Money Show at etnow.tv from Shyamala Reddy. She says, I'm a housewife of 52 years old. I shifted my fixed deposits amounting to nearly 25 lakhs into 4 debt mutual funds in October 2017. From the 3 debt funds, I started investing in equity mutual funds via the STP route since the 1st of January this year. The time horizon for the equity funds is about 9 to 11 years, and here are the investment details. So the debt mutual funds include Franklin India Short-Term Income Direct Growth. She's got about 10 lakhs there. Franklin India Ultra Short Fund, Invesco India Ultra Short Term Fund Direct Growth as well. Kotak Low Duration Fund Direct Growth. Monthly STPs into these mutual funds for the next 5 years or so includes Franklin India Tax Shield Fund, Invesco India Growth Opportunities, Kotak Emerging Equities Fund. Now she asks, is my strategy of investing in mutual funds a wise decision? Are my debt mutual funds and equity funds the correct suggestion? Please advise if I need to make changes. So it's been a very smart approach because actually her email stated that she'd been given this sum of money years ago, consistently putting it in fixed deposits and making returns on that. And it looks like she's taken the plunge to invest into equity mutual funds and debt funds very recently. So I think she's a little bit apprehensive as to whether this strategy or not is a wise decision. But I'm sure, Tarun, eyes closed, you're going to say it is a great decision that she's made. Walk us through, a lot of people are confused between this, mutual fund versus equity MFs versus fixed deposits rather. What's the outlook there and how are you assessing her entire portfolio?
Yeah. So, first of all, congratulations, Shyamala, for taking this first step. I can clearly see that it was not an easy decision for you to move the money from a fixed deposit oriented strategy to a market driven strategy. But I could see a very, very serious effort has been made from your end. The strategy which you have selected, the STP strategy, systematic transfer plan strategy, looks wise to me because at the age you are in right now and the kind of time horizon you have and the kind of market conditions we are in, I think this strategy is just perfect and just correct. So and the scheme selection which has been done by you, I think all these 3 schemes are purely equity oriented strategy, wherein one strategy is a focused equity linked savings scheme which gives you benefit under ATC also. So which in current scenario all the 3 schemes look good to me, but looking at your age, my one suggestion to you would be to add a bit of balanced strategy, a balanced fund in your portfolio, because to me market doesn't look as a secular in next 5 to 6 years kind of horizon. So it's better you stagger your money into various strategy, and a balanced strategy would be a strategy which will give you protection at the same time growth both in your portfolio.
Okay, so just let's look at some of those debt funds that she has. Franklin India Short Term, Franklin India Short Term Bond Fund, Kotak Low Duration Fund. How are you looking at some of these debt instruments that she's got, or debt mutual funds as well as the equity mutual funds? How are you reading into the selection that she's made? Is it a good selection? What are the tweaks and changes?
So the fund selected by her has been more like a short-term oriented fund. So the return expected from these funds are not expected to be very high. So that is one expectation build up you need to have right now only, because these are all with a normal average duration of less than 6 months to 1 year. So the return potential of these strategy in terms of debt returns will be low only. But since I can see that the whole purpose of using this vehicle is to invest into systematic transfer plan, so I don't see that as a problem, because your underlying main focus is to get this money parked into equity over a period of time. So it is right to park this money into a low risk strategy, which is all these short term funds are will help you do that. But you can always look at other debt strategies like which could be a comparable strategy to fixed deposit, like corporate bond strategy as well as credit risk funds, because these funds can help you achieve better than fixed deposit return post tax, as well as liquidity is also available all the time.
Okay, so there you have it. That's the exact advice as to how, you know, your portfolio can be assessed. But no doubt you have made the right decision, Ms. Reddy, by putting your money, a well calculated and thought out decision, into debt and equity mutual funds, and I think that will work wonders for you. Do remember, if you have any further queries as well, you would like to elaborate, start putting your money in other kind of mutual funds, feel free to email us on the money show at etina.tv. And do remember, Tarun Birani is with us today on the show. If you have any questions or queries, please feel free to dial in. There's a number. We're encouraging that we'll be taking on all your live calls. Okay, let's move on to the next question for the day. Shrikant C has sent it in. He says, I'm 45 and working in a software company as a recruitment professional. In my retirement age, I would like to be financially strong. I am ready to invest in mutual funds. Please guide me. Which fund manager should I choose? Which mutual fund should I invest in? I want to have at least 1.5 crores by the time of retirement. So he's about 45 years old. There's not too much time left, and it seems like he hasn't invested any money in mutual funds as a route previously. So this is probably, you know, a first time investment. In light of this, what advice would you like to give him at the time of retirement? Close to 15 years from now, he wants 1.5 crores. Which are the funds on your radar, Tarun?
Yeah, so Avni, I don't feel he doesn't have time in hand. He has good amount of time in hand, because we have worked around with a lot of clients who have just started getting into financial planning as well as investing around this age, because traditionally last 10 years, if you look at, people were not educated around this concept of investing, mutual funds and etc. Due to that, a lot of people have started late. But now, looking at his specific requirement, I think it is very much possible to create a corpus what he is targeting, around a 1.5 crore corpus. I would strongly recommend him to have a mix of strategy. This strategy can be a mix of multi-cap strategy. It could be a one multi-cap strategy, one mid-cap strategy, one balanced strategy. Could be a mix one he can select. I would go for a Mirai fund for the multi-cap strategy, as well as SBI fund for multi-cap strategy. And for mid-cap, he can look at Franklin India Prima fund, and for balanced strategy, ICICI balanced strategy.
There you have it. That's the view coming in. Lots of funds that have been recommended to you. Mirai Asset India Equity Fund, SBI Magnum Multi-Cap, Franklin India Prima, as well as ICICI Pru Equity and Debt Fund. So what are you waiting for? Go ahead and start these SIPs. Well, let's move right on, and we have our fund review segment. Today on the show, it's the SBI ETF Nifty 50 that we will be discussing, with assets of about 39,000 crores. It's an equity large cap fund with an expense of 0.06%. And we want to just get in a view as to what exactly the outlook is. Incidentally, if I'm not mistaken, it's India's largest equity fund, because the EPFO has put in money into the SBI ETF Nifty 50. Would just like to get in your thoughts as to what this fund is in terms of a rating on 10, who is it suitable for, and why you believe so.
Perfect. So ETF as a concept, exchange traded fund as a concept, is catching up, at least in developing market like India, of lately. But if you look at developed markets like US and Europe, I think 60 to 70% of incremental money flows into ETFs. The good part about ETF strategy is it is low on expense. It's a passive strategy which mimics index as defined by selected by the investor. In India, one of the most prominent index available is Nifty and Sensex, and under Nifty, this SBI ETF is where the focus is, investing focus is. And for ETFs, the most important tracker is to identify what is the tracking error these funds have, and SBI ETF tracking error is on a lower count, and being a very big fund, it has economies of scale also. So I feel this fund can be looked at for any allocation towards Nifty strategy. Yeah. In terms of suitability, what you have asked for, this is suitable for investor who is looking at a long-term wealth creation. If you look at last 10-year returns of these strategy, the returns have been around 10 to 11% in 10 years. But going forward, I see ETF as a strategy makes a lot of sense, because efficiencies in the market is picking up in India also, and we can see that stock selection is getting more and more difficult for asset managers today. So it makes a lot of sense. So the expense ratio of this fund is 7 basis point, which is very cheap compared to any active fund which is in the range of 2 to 2.5% on a regular plan. So and over a period of time, I see these ETFs can deliver better returns than active funds. So makes a lot of sense to get into this strategy. In terms of my score, I would give 6 to 7 out of 10 to this fund. Yeah.
All right, that's the take coming in on the fund. I hope you've gotten a view as to who it's suitable for. A rating of 6 on 10. Tell you what, let's take a quick break right here on the show. Come right back. Our phone lines are open. Tarun Birani is with us to answer all your questions on mutual funds, as well as some Jannivesh queries coming up on the other side. We're in conversation with Arun Birani, who is advising all of you on your mutual fund strategy, how to prune your portfolio and save up for your goals. But let's move on, and we've got the biggest education initiative, that's Jannivesh, and it's inching towards the 10 lakh mark. And a big thank you to all of our viewers who've become a part of this movement, and those of you who have not yet, please do remember you can pledge just 1 day of your income into mutual funds, and the benefit is all for you to see. Here's your chance to be a part of the initiative. All you have to do is pick up the phone and give a missed call, 1-800-833-666. That's 1-800-833-666. We already have a massive 9 lakh investments on pledges that have been taken with the Jannivesh initiative, which is in congruence with the National Stock Exchange. Well, let's move right on then, and let's get in a query, a Jannivesh question. Mahindra is with us from Chennai with a question for Tarun. Hi, good evening and welcome to the Money Show. What's your query?
Good evening, ma'am. I am 53-year-old man, retired, and I have invested in the following funds. Hello?
Yes, go ahead. Which funds?
I have invested Kotak, a multi-cap fund, say 4 lakhs, Birla Asset India Mutual Fund 4 lakhs, and Aditya Birla Sunlight Fertility Equity 2 lakhs, and SBI Blue Chip Fund 2 lakhs, and HDFC Balance Fund 2 lakhs.
Okay.
So whether I am in the right path where I should shift to some other fund or not, that I want to
So
know.
what's your goal? You're 53 years old. Are you just saving up for wealth creation and retirement?
No, it's for just after for. I invested a year back. I will hold it for another 3-4 years. So I need income from it after 4-5 years.
For some specific goal in the next 4-5 years. So he's very specific that he wants to invest. I don't know how you would categorize this time frame of 3 to 4 years, but certainly not long term. What is your advice, Tarun? Are his funds correct?
Yeah. So I think most of his funds are equity oriented funds with I think out of 5 funds which he mentioned, three funds are pure equity and couple of funds are balance oriented strategy. So I think the kind of time horizon he is looking at, 3 to 5 year horizon, the best strategy and most suitable strategy according to me is a balance strategy. That's where he should focus on, because equity in 3 to 4 year horizon, we have observed that around 10 to 20% times it can give you negative returns also. So balance strategy can give him protection as well as good returns. So that is my piece of advice to him. Okay,
that's the take. Let's connect with Satyajit from West Bengal with a question on the show. Hi there, welcome to the Money Show. Satyajit, what's your question?
Good afternoon, madam.
Good evening.
Good evening. I'm Shastraji Samantra from West Bengal. I'm at the age of 40 years.
Okay.
So I'd like to invest in mutual fund, which give me the monthly dividend in a higher ratio. Please give me the names of some mutual fund through which I can get the return of monthly basis in some higher in the mutual fund. That's what I want to know actually.
Do you want to stay invested for a long time frame?
No, ma'am. What I want, I'd like to invest lump sum amount, which will give me the good monthly return.
Okay.
So that that's important for me. That's why I'm asking so.
Okay, he's very specific about the lump sum amount, good monthly dividend. Which funds are on your radar, and what do you make of his strategy as well, Tarun?
Yeah, so Mr. Satyajit, the way you are looking at mutual fund to start generating dividends, I think the post this budget, we have seen changes in the taxation policy for most of the equity balance funds, and I don't see it's a prudent strategy to go for a dividend oriented plan, because you will get straight away 10% dividend distribution tax, which will be levied on any balance or equity fund at this point of time. Apart from these, the debt funds, dividend on debt funds is also subject to almost taxation similar to your income range. I'm assuming, let's say your income range is in the highest slab, so you'll end up paying almost 30% plus tax. So according to me, taking a dividend plan in this current new environment post this budget is not a right strategy to look at. First of all, now what is your objective? I'm not very clear on what is suitable for you. Can be assessed post identify. Is regular income a very clear cut objective what we are looking at? What is the time horizon of this investment? Can you park this fund for say 10 years, 5 years? So I'm not very clear, but let me give you some scenarios where, let's say, if you are looking at this investment for more than 5 years, I would strongly recommend that make a mix of balance as well as debt funds, in which the balance funds after after a completion of 1 year, and in balance fund also look at dynamic asset allocation strategy, which are dynamic in terms of equity selection, which can help you reduce your risk dramatically. And post completion of 1 year, you can look at a systematic withdrawal plan wherein you will start withdrawing a specific amount what you are looking at on a regular basis, and this is much more tax efficient also, and you will not have any deduction of tax at the mutual fund end. So it is solely at your discretion, based on your income slab, the tax will be levied. So balance fund can be looked at. Apart from that, debt funds also can be taken in your portfolio if your risk profile, so based on your suitability, we can identify what is the risk profile you have, and if it is low, debt funds can be selected. And in these debt funds, my suggestion would be post completion of 3 years, a systematic withdrawal plan would be most efficient, because your taxation will be very low in that. So I think your case need to be understood in detail before giving a very specific suggestion.
Maybe
so
you can email us, with your details on the Money Show at etnow.tv to get specifically more details. But that's the advice coming in. I believe our phone lines are buzzing. Abhishek is also with us now from Nashik. Good evening, Abhishek. Welcome to the Money Show. Tell us, what's your query?
Hi. My query is that I am 48 years old, and I want to, I have a corpus which I want to invest lump sum for my retirement. So I would like to start STP after 10 years, but I want to invest now. And I have chosen 2 funds. One is ICICI Balance Advantage Fund, and the second one is HDFC Equity Saving Fund. So I would like to know whether these are the right choices, since I don't want to take too much of risk.
Just to make it clear, you have already put in money into these 2 funds?
No.
But you
so
want
I
to
have
wait 10 years before you put into these funds?
Yeah, no, I have the corpus ready, and I would like to invest now.
For the next 10 years?
Yes, so I would like to know whether around 10% returns are possible with these 2 funds after 10 years, and also what would be the tax scenario, particularly with balance advantage fund?
Okay, how would you look at these two funds, Tarun?
So both these funds mentioned by him fall under the hybrid category, and the balance advantage is a dynamic asset allocation strategy which keeps changing the debt equity structure ranging from 30% to 80% on any day level. So let's say if the market goes down, it will increase the equity level, and if the market goes up, it will reduce the equity level. And I feel to mitigate the risk, it is one of the finest strategy to look at. And this ICICI balance advantage has a very good track record in terms of performance in bad markets. So this is definitely a good strategy. Another strategy which he spoke about is a equity saving strategy. This strategy also have a equity component in it, and it can go maximum as high as 30% into equity, and they keep changing the equity debt level based on the market scenario. Talking about taxation for both these strategy, it is similar to what equity strategy taxation is. That is, post 1 year, the long-term capital gains of 10% will be levied, and less than 1 year, 15% short-term capital gain will be levied. But looking at the time horizon, what he is looking at, 10-year horizon, I don't think both these strategy makes a lot of sense at this point of time, because 10-year horizon is a very good time in hand with him, and putting money into these low risk strategy, he will be compromising the returns. Again, his risk tolerance level need to be understood in detail, but let's say if his risk profile falls under a medium to aggressive investor segment, then what I would have recommended him is to put money in the liquid strategy right now and take as STP plan, systematic transfer plan, wherein from liquid fund to equity fund for next 3 years money will be transferred, so that he will get rupee cash cost averaging benefit. And I think in 10 years his returns of 10% plus can be easily achieved. That's what my sense is.
I hope, Abhishek, we were able to answer your question. And Tarun, pleasure having you with us on the show. Many thanks for joining in. Remember, if we weren't able to get your questions answered today, you can email us on themoneyshow@etnow.tv. Thanks for watching.